Good day, friends. Today we will discuss joint venture ratio or valuation of joint ventures. So, first of all, we will discuss what is a joint venture property or what is joint venture development of property. It is a collaborative arrangement where two or more parties, typically developers and landowners, come together to undertake a real estate development project. So here at least two persons are involved. One is owner who gives his land, and the other one is developer who develop the land, who invest capital, who he may invest in the form of capital, or he may give his expertise or other services as shares in the project's risk, cost, and profit. So here we will now discuss what a few key aspects of joint venture. First thing is shared resources. So what the parties do, they pool their assets and expertise to achieve a common goal. Then risk mitigation. So by sharing the risk, parties can take on larger or more complex projects than they could do individually. And then profit sharing, how the profit is shared. So profits from the developments are distributed. How it is distributed according to the terms of the joint venture agreement. Then clear roles and responsibility. So whenever an agreement is formed for joint venture, it should contain clear roles and responsibility of each and every participant. So each party's roles, responsibilities, and contributions are clearly defined in a formal agreement. So this type of agreement can be beneficial as it allows pooling of resources. What did joint ventures do? Here, the resource pooling of resources is done, and of course, expertise potentially leading to more successful projects. It is essential, however, to have so for joint venture for its successful, we should have a well-defined drafted agreement to ensure that all parties are clear on their obligations and entitlements. So, how the valuation for joint venture development of property is done? First thing is determine contributions. So, we have already discussed that one or the two other persons he will give his land or property. So, one partner may provide existing property or land for joint venture. So then capital, the money required for the development may come from a different partner. And then skills means project management, construction services, and development skills are further possible contribution. It may be third person, or maybe that the person who is providing capital, he is also providing skills. So then after determining the contribution of each and every partner, we will establish equitable value of each partner's contribution. So fair market value must be assigned to each contribution. So this can be, however, it can be difficult, particularly when it comes to in-kind gifts like, so you can do the valuation of land or immovable property, but when it comes to things like knowledge or exclusive technology, so though they are difficult to find out its equitable value, but we have to do that. So typical techniques consist of, we can do it by comparable sales for land or property, use current sales, recent sales of similar property. For construction and development services, we can apply cost approach to estimate the cost to replace these services, and the for contributions that generate income, we can apply income approach such as rental property use discount cash flow analysis. So method of valuation for joint venture which is discounted cash flow. You already know. So what here we do, we estimate the future development related cash flows, and these cash flows are then reduced to their current worth. Then comparable transactions to establish value, compare comparable joint venture agreements in the market. Cost approach, add a profit margin to the total of all contributions costs. Then profit sharing and ownership. Establish the ownership percentages. See here, you have to establish, first thing you have to establish ownership percentages, how much each person has contributed, and then you have to find out profit sharing plans. So these profit sharing plans are based on the contribution valuations. So this guarantees the input value of each partner is reflected in their shares. Then evaluation of risk. Of course, all these such projects are associated some risk. So analyze the developer's risk, including the hazards related to the market, constructions, and finances. To take this risk is to account, adjust the valuation. Then you have to take into consideration tax and legal aspects. Make sure that all legal and tax requirements are met. This entails being aware of the effects of real estate taxes, capital gain taxes, and other pertinent taxes. Then, of course, you have to decide exit strategy and governance. So, clearly define your exit strategy and governance frameworks. This covers the procedures for making decision, methods of resolving conflicts, and the terms under which partners can terminate the joint venture. So, for initiation of joint venture project, these things have to be carried out, and how the valuation of that joint venture as a whole is to be done, this procedure has been explained in these slides. So now we will discuss certain formulas which are useful in joint venture valuation. First thing is FSI and FAR. As an engineer or as an architect, you know FSI or FAR. This is equals to total cover area of all floors divided by total plot area. Then undivided share of land. So what happens? Let us suppose that this a an apartment building which consists of 3 stories. So owner of all these stories, first, second, and third, they have the share of in the land over which this apartment has been constructed. So this share is called undivided share. We generally call it UDS. This is equals to covered area of particular flat divided by FSI. So covered area we generally take as super built up area of the particular flat for which you have to find out UDS divided by FSI. How it is done we will discuss in the coming slides. Then total value is equals to land component plus building component. So land component it is equals to land rate divided by FSI. Percentage of common area, this is equals to total common area divided by sum of plinth area of all the flats multiplied by 100. So when you have to find out joint venture ratio, remember it is always share of the promoter comes first and then share of the landlords. It is like written like this. So first thing you must understand what is this land component, how it is equals to land rate divided by FSI. So let us suppose that FSI is 1 is to 2. 1 is to 2, it means over 1 square feet of land over 1 square feet of land, what you can do, you can construct 2 square feet of building. Over 1 square feet of land, you can construct 2 square feet of building. This FSI means what this FSI, of course, on all the floor, it may be on one floor, it may be on 2 or 3 floors, depending upon the building bylaws. But as far as this FSI is concerned, if FSI is 1 is to 2, it means over 1 square feet of land, you can construct 2 square feet of building. So if you have to find the cost of 1 square feet of building, let us suppose you have to find the cost of 1 square feet of building. So 1 square feet of building, it will be equals to 1 square feet of building plus land required for 1 square feet of building. Land required for 1 square feet of building. So how much land will be required? It means for over 1 square feet land, you can construct 2 square feet of building. For 1 square feet of building, how much land you require? You require 1 over 2 square feet of land. So 1 over 2. 1 over 2 means 1 over 2. This 2 is FSI. So for constructing, cost of construction of flat or a composite rate, it will be consisting of cost of construction of 1 square feet of building plus cost of land required for constructing 1 square feet of building. So cost of construction of 1 square of building plus how much land is required? Required 1 square feet of land. This is 1 square feet of land divided by this 2 is FSI. So 1 square feet of land divided by FSI. So for example, plot area is 2000 square feet and total covered area of all floor is 5000 square feet. Then FSI will be equals to 5000 divided by 2000, 2.5. So if plot area is 1 unit, total coverage is 2.5 unit. It means over 1 square feet of plot, you can construct 2.5 square feet of building. So for 1 square feet coverage, for 1 square feet building, you require plot area that will be equals to 1 upon FSI means 1 upon 2.5. So cost of 1 square feet of coverage is equals to 1 square feet cost of building cost of 1 square feet plus land cost of 1 over 2.5 square feet. So 1 upon 2 upon 5, it is 1 upon FSI. So that is why we take this land component as land rate divided by FSI. So we will take some examples that will make the things clear. In a plot of 1632 square feet, the landlord Mr. Sachin and developer Mr. Sushil intends to construct an apartment through joint venture. The total built up area is 32640 square feet. There will be total 20 flats. Each flat will have a built up area of 1632 square feet. The prevailing market rate for land in the area is 12,000 per square feet and cost of construction is 2,800 per square feet. Assume the promoter's profit as 20%. What is the floor space index or FAR or FSI? You know it is equals to total built up area divided by plot area. Total built up area, plot area is given to you as 16320 square feet and total built up area is given to you as 32640 square feet. So FSI is 2.2, 2. So what is the UDS of each flat? So built up area of each flat is 1632 square feet and you have to divide it with FSI. FSI is 2. So undivided share of land for each flat will be 816 square feet. What is the composite rate of flat? So undivided share, you know it is 816 square feet. Land rate is 12,000 square feet. So land component will be 816 square feet multiplied by 12,000 per square feet. Though this is the land component 97 lakh 92,000. Built up area is 1632 square feet. Cost of construction per unit, you know, 2800 square feet. So building component will be 1632 square feet multiplied by 2800 square feet. So 45 lakh 69,600 will be the cost of construction. So total 97,000 97 lakh 92,000 plus 45 lakh 69,600 1 crore 43 lakh 61,600 will be the cost composite rate of the flat. So promoter's profit is given to you as 20%. So total selling price will be 1.2 into 1 crore 43 lakhs 61,000. So total will be 1 crore 72 lakhs 33,920. So this will be the total selling price of the flat. So composite rate, total selling price divided by area of the flat, 1632 square feet. So it will be 10,560 square feet. So what is the selling price of each flat? We have already calculated 1 crore 72 lakh 33,970 920. Sorry. Otherwise, you can find out built up area is 1632 square feet and composite rate is 10560 square feet per square feet. You can calculate this way also. Otherwise, you can directly write it 1 crore 72 lakh 33,920. So what is the joint venture ratio? Land component. This is land component. This is building component, we have already calculated. So in here you need not to add profit. Remember, percentage of profit is not to be added here. So total will be land component plus building component 1 crore 43 lakh 61,600. So what will be the landlord's share? 97 lakh 92,000 divided by 1 crore 43 lakh 61,000, 68% is the landlord share, and developer's share 45 lakh 69,000 divided by 1 crore 43 lakh 61,600, 32%. But you have to write joint venture ratio. Developer's share will be written first and then landlord shares. It will be written as 32 is to 68, not as 68 is to 32. This is wrong. So whether there is any impact of guideline rate while fixing the composite rate of in and joint venture, no guideline rate, no rate while fixing the composite rate. So guideline rate has nothing to do with that. Another example, Mr. Bedi is having a commercial building 30,000 square feet constructed over a plot of 15,000 square feet. He wants to sell one shop of plinth area 1500 square feet to Mr. Krishna. He approaches a valuer to suggest him UDS of the land of the shop for the purpose of executing a sale deed in favor of Krishna. The common area percentage is 10%. So you have to find out what should be the UDS in this case. Plot area is 15,000 square feet. Built up area of the building is 30,000 square feet. Plinth area of one shop which has to be sold is 1500 and common area of one shop is 10%. This is what is given to you in the data. So building area, this is given to you, so you can find out FSI. FSI will be 30,000 divided by 15,002. So plinth area here the shop is 1500 square feet. Common area percentage is 10%. So total built up super built up area will be 10%, 1.1 of 1500 1650 square feet. So UDS, it is super built up area divided by FSI. So super built up area is 1650 and FSI is 875 square feet. So see here, he has asked you to find out only the UDS in the question. So you find UDS in this way, you know the formula for UDS, undivided share of land. So in the sale deed, so this area will be mentioned as undivided share of land. Another question that will make the things more clear to you. Joint venture development project is proposed at Kolkata. Area of the plot is 12,000 square feet. Sorry. Permitted FAR on the plot is 1.80. Cost of construction is 650 per square feet. Sale rate of the flat is 1800 per square feet. Find out the share of landowner in the new construction to be undertaken on the plot. The cost of finance is 14% of cost of construction. Developer's profit is 30% on his investment. Administrative and other expenses are 5% of the cost of construction. Assume 10% area for free balcony area. This is given. Assume it takes 2 years to construct and sell the project. This is the data given to you. You have to find out what you have to find out. You have to find out share of landowner in the new construction. See here in the question what he has asked you to find out. So total permissible area, it is given to you 12,000 square feet is given to you, and 10% free area for balcony is given. So total permissible area multiplied by 1.8, it is FSI. So 12,000 plot area multiplied by 1.80 as FSI and 1.10 for 10% extra area. So total built up area or total permissible floor area can be 23,760 square feet. So total value of all the flats means he can construct this much of area at the rate of 1800 per square feet. Rate is per flat rate is composite rate is 1800 per square feet. So total earning maybe from the project is 4 crore 27 lakh 68,000. Now see the expenses. Expenses to be incurred by the developer. Cost of construction 23,760 square feet at the rate of 650 square feet, 1 crore 54 lakh 44,000. So 14% he has to take loan. If you have to take the loan, it will cost him 14%. So 14% we will assume that he has taken the loan for 1 year. So 14% for 1 year, so interest will be 14% of 1 crore 54 lakh 54,000, approximately 21 lakh 56,000. So total investment as per the given data is 1 crore 76 lakh. So now again it is given that 30% developer's profit on his investment, only on his investment with 30%, it means 52 lakh 80, 30% over it is 52 lakhs 80,000. Another thing is given administrative and other expenses at the rate of 5% of 154 lakh. So that will 5% of 154 lakh is 7 lakh 70,000. So if you calculate total expenses, so it is 2 crore 36 lakh 50,000. So now see here, this is the total expenses and total which he can, which total value as on date comes out to be 4 crore 27 lakh 68,000. So from here you can find out the developer's share. So developer's share will be 2 crore 36 lakh 50,000 divided by 4 crore 27 lakh 68,000. So developer's share is 55.29%. So it means 55.29% means 55.29% of 23,760 means out of this much will be the share of the developers 13,136 square feet. It means balance 44.71 share will go to the landowner. Means 44.71% of 23,760, it will be 10,623 square feet of area. So landowner is entitled to 44.71% share in flats. So total saleable area for developer is 10,623 square feet multiplied by rate per square feet. You know it is 1800 per square feet. It means total value of owner's flat, it will be 1 crore 91 lakh 21,400. So this is all about joint venture valuation. If you have anything to share, you can share on our YouTube channel. Please like, share, and subscribe. This is our YouTube channel for more educational videos on valuation and other related videos. Of course, these all videos are free of cost. If you have any suggestion, please comment. Your suggestions are always welcome. Thank you. Thank you very much. Have a nice day.